Hi, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas, and I teach intermediate accounting 1 and 2. We use, and I'm be using here really today are my own examples, but we use the McGraw-Hill, Spicer, Nelson, and Thomas textbook. And so, may refer to that from time to time. I think today, these are mostly examples I've created. And we're going to be talking about the cash flow statement today. I'm going to be creating cash flow statements from income statements and balance sheets and a little bit of supplemental information. This would be, and I have a long career in accounting, working for 2 large global companies. This is basically how cash flow statements are done. Now, if you get in a large global company, you got to deal with currencies and other kind of issues that make it, a hell of a lot more complicated and difficult. But the concept's the same. And so you should be able to walk out of my class in this chapter and be able to go do some cash flow statements. And so again, I would encourage you as I do these 3, maybe you watch one and then pause it for the second and third one. I'm gonna do 3 cash flow statements, and maybe you practice and you see how this works. So again, thank you for participating. This is the last chapter, the last lecture for intermediate accounting, both 1 and 2, chapter 21. So congratulations for those who hung with me, and appreciate it for sure. So I'm going to start here. If you've been watching some of my lectures, you know that I like to use a kind of a summary sheet on each one, and this is my summary sheet for the cash flow statement. This is in somewhat for the cash flow statement. It takes that whole chapter and all the lecture slides I just did, spent maybe 45 minutes on or whatever, and boils it down to one piece of paper, kind of if you will, a cheat sheet for doing a cash flow statement if you're doing one. So again, we're going to take the balance sheet and we're going to go, and the income statement, we're going to create a cash flow statement. So again, the thing that's not on here is we're going to start with net income and indirect method, and we're going to add or subtract non-cash items in net income. So this is getting back to balance sheet adjustments and where do they go. So by the way, an increase in an asset is a negative cash flow. That makes sense. Debit the asset, credit cash. I got to buy the asset right. But if asset declines, it's a positive cash flow. Maybe we sold a bunch of inventory this year, more inventory than we started with. That's a positive cash flow. I didn't have to buy more inventory. So that when I have that, it's going to be a positive cash flow. Or when I sell a factory or sell a piece of land, I'm going to debit cash, credit that land. So the asset's going to go down, the cash is going to go up. And so assets work in the opposite direction. They're an inverse relationship to cash flow. Liabilities or equities, they work in the same direction. If liabilities or equities increase, we have positive cash flow. If they decline, it's a negative cash flow. If I sell a bond, my bonds payable account is going to go up big. That was a increase in cash, same direction, because I got cash in. If I go retire a bond or I buy back stock, remember from one of our earlier chapters, treasury stock, equity is going to decline. Treasury stock's a debit. What's a credit for that transaction? Credit to cash. Debit treasury stock, credit cash. Therefore, it's going to be, is equities decrease, it's going to be a negative cash flow. We're going to credit cash, and that's debit treasury stock, credit cash. So I get a little bit lost there. So again, these are the rules from the balance sheet, the cash flow statement. Next set of rules, where do they show up on the cash flow statement? Change in operating, what we call operating assets and liabilities, current assets and current liabilities. Nearly all of these are going to go into the operating section. And the change in long-term assets, that's going to go into the investing section of the cash flow statement. And we'll see this in a minute. I'm going to work 3 examples. And a change in the long-term liabilities and equity, that's going to end up in financing. So let's go do some cash flow statements. I'm going to do 3 of these today. And I do start with, I do it this way. Number 1, guess how great my handwriting is. If you guys have watched my lecture, you know my handwriting is not that great. But here, at least for the labels, it's going to be fantastic because I have a template here. And so let's go then, and I'm going to move this over here. That'll work there. So I'm going to go from a balance sheet and an income statement, and I'm going to create a cash flow statement. I am going to use there's more information that's not here that I'm going to have to understand, because property, plant, and equipment, let's just look at that. It went from 225 down to 225, but there's a lot of stuff that happened in there. We acquired some for 30. We sold some, the book value went down 25. We may not have sold it for 25, and depreciation. We're going to have to use all three of these things, not just the $25,000 reduction. So let's get started. I've got my net income. I've also got a long-term debt roll forward, and I got to see what happened in retained earnings. Now, I will say this: every dollar change on the balance sheet is going to end up somewhere on the cash flow statement. So let's get started. I'm going to use the indirect method. So I'm starting with net income. I go to the cash flow statement. I'm doing the third example, but that's okay. And I'm going to start with $40,000 of net income. I'm going to add or subtract back any things in the net income that weren't related to cash. Well, first of all is depreciation expense. So I'm going to pull up that 30, and that's going to be depreciation expense reduces net income in a non-cash way. So I'm going to have to add that 30 here. And then I have a gain on the sale of assets. Let's see where we can find that. Oh, these things are right here in the, there's depreciation expense in the income statement. You see that's an expense. And then, but we have this gain on the sale of plant assets. Now, by the way, that is cash related. It's not non-cash, but it's not operating cash. That gain relates to equipment that we sold that would go in investing. So I'm going to have to subtract. That was a plus 15 in the income statement. So I got to subtract that. I got to get it out there. Minus 15. Now I'm just go down the road here. Change in accounts receivable. They went up by 10, opposite direction on the cash flow statement, minus 10. Change in inventory, and I'm pulling these things right up here. I got already done the math for me here. Inventory went up by 25. That's minus 25. Change in prepaid expenses. They went down by 5, also opposite direction, plus 5. And then that's done with current assets. Remember, current assets and current liabilities end up in the operating section. So liabilities work in the same direction on the cash flow statement. So accounts payable went up by 20. That means we bought some inventory that we didn't pay cash for, more than 20. It's the same direction, plus 20. Salaries and wages payable went up by 5, plus 5. And accrued liabilities went up. So all of our current liabilities went up in this case. And so let's just get the old calculator out here. I'm going to add these down. 40 plus 30 minus 15 minus 10 minus 25 plus 5 plus 20 plus 5 plus 15. Okay. And we'll assume these are thousands. So I've got my operations, we made net income of 40, but we generated cash of 65,000. How do we do that? Well, first of all, we add back that 30, that's one piece, but it looks like we did a really good job of managing some of our payables. And, I guess we slow paid them, if you will, from one side. Let's go do investing. And this all around buying and selling long-term assets. So we acquired some assets. So let's go see acquisitions plus 30. Again, remember, Assets go in the wrong direction. So that was a plus 30. This becomes a minus 30. And you can think of it that way, formulaically, like I just, because that's how I set you up to do this. But you know, if we acquired assets, plant assets, that means property, plant, equipment, took cash to do that. So we paid cash for that, right? So it makes sense as well. Now, the proceeds from sale of plant assets, we've got, here's an issue here, because the book value of these was 25 in the wrong direction to plus 20. Let's just think about this for a second. These plant assets, net book value, we sold. And we're trying to get to, we recorded a gain. We know that already. We had a gain of 15,000. So how much cash did we receive? If we received more cash than the net book value, then that is a gain. So we must have received, proceeds means cash receipts. We must have received $40,000 of cash, you know, for these investments, because they were on the books for 25. And so that $15,000 gain sitting on the income statement, you know, is that's how we get to the 40. So we have to kind of think through this logically. We know that 25 went out. So another way of thinking about this, from the way I've been like talking to you, plus 25 because of the different direction, minus 25 to the plus, and then that minus 15 up here gets moved down, plus 15. So if you want to think about it formulaically, you could think about it that way. I really, quite frankly, prefer you to think about it, go through the logic of it. If we sold 25,000 of assets for a gain of 15, we must have sold them for 40. So think about that logic. I think that's much better for you. And it says here, loan to another company. Let's see, I don't know if we have that. Oh yeah, look, we've got a long-term note receivable. How do I know it's long-term? Well, it's listed down here with the long-term assets. If it was a current note receivable, it would be up here. And so that note receivable increased by 15. And we know, we'll just use my logic, assets go in the wrong direction, minus 15. And let's think about it. So I use the formula, assets went up, negative on the cash flow statement. But let's think about what does that mean? Our notes went up by 25. Means we loaned a company or someone an additional 15,000. Means, you know, it's a receivable, right? So we gave them our cash and they owe it to us, note receivable. So we debited note receivable and we credited cash. Does that make sense? So why that plus becomes a minus. So let's just do our math, 30,000 negative, 40 plus, 15 minus, and that I think minus, that's going to be, I can just do the math in my head because my calculator was blowing up on me. I know that was the wrong answer, minus 5. So I say minus 30 and that's minus 45 plus 40. So we have, you know, you could say negative cash flow from investing. A lot of times we use this word used by investing versus, you know, here a positive number means the cash was provided by operations, but we use some cash for investing. We're getting to the end here. Now let's go look at, so cash flow from financing is all about related to long-term debt and changes in equity. So long-term debt went up by 25. Again, same direction. So that's going to be a plus 25. But here is the issue here. If I want to like highlight this, beginning balance of 50 and went up by 25 to 75. However, here we've got a little issue with the accounting rules because accounting rules don't let you net new debt with old debt. You have to separate out the two. Any new debt that you went out and issued and got cash for, you've got to disclose that. And if you paid off some old debt, you got to disclose at two separate places. So this $25,000 increase from 50 to 75. We issued new debt for 125, and we paid some old debt off at 100. And see, that tells a little bit different story. We issued some new debt and paid some old debt. Maybe that had a higher interest rate or something. You'd want to go look at your interest, your debt footnote to kind of understand that. Well, so we know the issuance is the plus 125. That's the same direction too. And we paid some debt off minus 100. So I've got my $25,000 increase there. All right. Issuance of common stock. Did we issue any common stock? Oh yeah, up 25, 245 to 270. So we must have issued some. We don't have paid in capital, so this must be no par common stock. And then how about payment of dividends? Where do the dividend payments happen? They happen in retained earnings. Well, retained earnings went up by 35. Well, we come over here. It went up by 35, but plus 40 for net income, minus 5 for dividends. I could leave this out and you would know, hey, it went up by 35, 40 for net income. So we must have paid 5,000 in dividends. So you could do it that way. Minus 5, payment of dividends. All right, let's go through this. 125 plus 25 minus 100 minus 5, and I've got plus 45. So what is this telling us right now? Well, we issued, net $25,000 more in debt. We issued 25,000 in common stock, so we have kind of like $50,000 in increase in debt and equity, paid 5,000 in dividends, and that with operations, boy, must have just gone to an increase in cash because we really didn't invest much. So let's see if that happened. Let's do our reconciliation. So beginning cash. Well, yeah, you can see right here, cash went from 45,000 to 150. Now, why are we holding so much cash? So the net increase or decrease in cash, that's going to be 65 plus 45, 110 minus 5, 95. Oh, that's it. 65, 110 minus 9, minus 5. So the increase in cash was 105. Again, this represents 65 minus 5, 60 plus 45, 105. What was my beginning cash balance? 45. I get that right straight up from the balance sheet where my cursor is there. 105 plus 45 equals 150. Is that my ending balance? Yes, it is. Meaning error-free. Home run for me on the first one of these. And again, I'll leave that up there for a minute for you to look at so you can see the answers there if you're trying to do this on your own. All right. Example number 2, going to work exactly like example number 1. So we've got start with net income. Here's the income statement. Here's the balance sheet. Here's my supplemental information. I'm going to use that again. I'm going to start with net income plus 50. It could be a net loss. You could start with a minus. Don't forget that. And I've got depreciation expense of 18. Add that back. Plus 18, and a gain on the sale of assets. By the way, if I had a loss, I would be adding that back, but I have a gain that's increasing this to 50, and that gain was 8, so I got to take it out, minus 8. If I had a loss, I would add it back. Now I'm just doing kind of the no-brainer work. Accounts receivable went up by 15, opposite direction for assets. Inventory went down by 3, opposite direction, plus 3. Prepaid expenses up by 1, minus 1. Now I'm in the current liability section, same direction. Accounts payable went up by 34, same direction, plus 34. Salary and wages payable, down by 2, same direction, minus 2. Accrued liabilities, down, minus 2. All right, let's add all these up. $77,000. So that's pretty good. We only made $50,000 in net income, but $77,000 of cash flow from the company. Where did that come from? Well, look, a lot of it just came out of this accounts payable. I'd want to understand more about that. You know, they're not paying their bills? maybe they got good terms from their vendors. Maybe they're just really smart business people. I don't know. It's interesting. Again, there's a story here. And so it might beg, you know, if the story is not evident, it might beg some more questions. So maybe if you're looking at the cash flow statement of a company you wanted to work for, there you go. You got some really intelligent questions to ask. You will look smart. You'll look like you've done your homework. And that will usually result in both of those in you getting hired, you know, maybe at a higher salary. So yeah, go for it. So now we're going over the asset side. Let's look at, again, acquisitions. So property, plant, and equipment went up by 124,000. How did that happen? We acquired 196,000. We sold the net book value 54,000, and then depreciation, which we've already accounted for on the income statement. So let's take care of this acquisition, plus 196. Proceeds from the sale of plant assets. Let's go see what we sold. 54,000 net book value. Did we have a gain or a loss? We had a gain of 8. So we must have received more cash than the net book value, 862, because 62 minus 54. So cash received looks pretty good. Plus 62. By the way, look at that. Minus an acquisition is a use of cash. You know, not, we don't receive cash when we sell, when we go buy an asset, we got to pay cash. Here we receive cash. Loan to another company. Well, look at this. Notes receivable went up from 0 to 21,000. So we went and loaned someone $21,000 of our money. I don't know why we did that, but I hope they pay us. So that's going to be a minus 21 because we gave them cash. Again, you can check yourself. Assets are up by 21, opposite direction, minus 21. So minus 196 plus 62 minus 121 minus 155. 196. Oh, I got the wrong answer. Somehow my calculator is not working. Like 196. Now there we go. 62 plus 21 minus 155. I just want to check because I don't want to have an error on that comes from my, I've worked these previously. I don't want that error. If I had an error to come over, so make sure I get this right. And so now we're down into financing. That's related to long-term debt and equity. So what happened to long-term debt? Let's go look forward on the balance sheet. It went from 77 to 160, $83,000 increase. Let's come over to our supplemental information. That's 77 to 160. 94 was from new debt, and then we paid off some old debt, maybe at a high interest rate. All right. So proceeds from issuing new debt plus 94 minus the payment of long-term debt plus 94 minus 11. That's an $83,000 difference. And now we've accounted for that $83,000 difference that's on the balance sheet. Everything on the balance sheet, every change is going to end up over somewhere over here on the financial statements, on the cash flow statement. Common stock, we issued 4,000 shares of common stock. So that's a +4. And dividends, I'll do it this way. Retained earnings went up by 33. Well, it went up 50 for net income. So +50 must be 17,000 in dividends. I come over here and my little supplemental, yes, 17,000 minus 17. So +94, +4, -11, -17. Let me get that in my calculator. +70. Now, 77 minus 155 plus 70 minus 8. So cash balance at the beginning, 42. Pulling that, watch my cursor there, and it went down to 34. Minus 8 plus 42 equals 34. Boom. Whew. That's 2 out of 2. I got one more to go. Let's hope we can get there. And you know, when you're doing an exam, you're going to go through this and you're going to find an error. So I know that'll be frustrating. You have to go back, check your signs, assets and liabilities, and your knowledge there. Now, notice when I say the cash flow statement tells a story. If we look at the balance sheet, all we see is cash went from 42 to 34. Wow, I don't know. That, like, what does that mean? You know? However, if I go look and said, hey, we generated $77,000 in cash from our operations. We took that and we used all of it to go buy some more equipment and property, plant equipment so we can grow. But we had to go borrow money to do that. So we borrowed, mostly came from borrowing another $70,000. Wow, those three numbers right there, they tell you a lot more than just looking at cash went from 42 to 34. That is big, really big. All right. I'll leave this up for a second so you can see kind of if you're trying to check your own answers for this. Oh, I lost it. Yeah. All right, we're bringing it home. We got one more problem to work on this lecture. This is the last lecture. I will, say that I pretty crazy. I locked myself in my home office, and I have done all of the lectures for Intermediate Accounting 2 in about 4 days. I must have a strong voice because my throat hurts because of all this talking. But 4 days, I've gone through all of these chapters for Intermediate Accounting 2. So yeah, I am definitely, it's Friday night. I'm definitely going to celebrate once I'm done with this last cash flow statement. But I never mind doing the problems. I enjoy. I mean, I love accounting problems, and I love doing cash flow statements. Maybe monotonous to do these. Now, I will note, especially if you're one of my students watching this, and they all groan when I tell them this in class, you're not getting this template on the exam. You're gonna have to do a cash flow statement, and I'm not giving you this. I might give the change in balances there at least, but certainly not giving you the template. You're gonna have to do that on your own, and hopefully your handwriting's better than mine, so I can understand it. So let's get going here. Enough talk. So we start with net income. Net income, 10,000. Depreciation expense, it was a $25,000 reduction in net income, but it was non-cash. So I'm going to add that back, plus 25,000. And we have another gain, $5,000 gain on the sale. That's increasing net income, but it relates to investing, so I got to get it out of there. Minus 5. Now I'm just going down, just doing my brain dead work. Accounts receivable went down by 20, plus 20, opposite direction. Inventory went up by 5, minus 5. Prepaid expenses went up by 2, opposite direction, minus 2. Accounts payable now are in the liability side, same direction. Accounts payable went down by 10, minus 10. And that makes sense because we paid some of last year's accounts payable this year. That's why it went down by 10. So it was a reduction in cash. And so again, the indirect method is so much easier. Salaries and wages payable up, that went up 2. So maybe some people who didn't pay, same direction, plus 2. And then accrued liabilities went down, same direction, minus 5. 10, 25 minus 5, 25 to 10 to, I got my math right. This is going to end up being plus 30,000. All right. Acquisition of plant assets. I'm going to pull that out of my supplemental information. So assets went up plus 100 for acquisition. So minus 100 on the cash flow statement. We had to pay for those. And then new assets. We sold assets, book value. We sold them. And then we know from the income statement, there was a $5,000 gain. So we must have sold them for 30,000. They were on our books for 25. We sold them for 30, 30 minus 25, gain. That gain goes on the income statement, but it shouldn't be on the income statement. It should be down here. So plus 30 from proceeds from that asset. Now, notes receivable minus 25. We know from my shortcut rules that needs to be a plus 25 here, opposite direction. But let's think, why is that? Well, we had a loan note receivable outstanding at the beginning of the year, and now it's down to 0. What does that mean? They paid us. It was debit cash, credit 25,000 for the note receivable. So that debit of cash now ends up on the cash flow statement. Minus 100 plus 30 plus 25, that's going to end up being minus 45 for investing. We're bringing it home. And let's look at the long-term debt roll forward. We issued $50,000 in new debt, and we paid off a lot of old debt for a $60,000 reduction in debt from 80 to 20. New debt plus 50, payment of old debt minus 110. So plus 50 minus 110, that's a minus 60. And if we come over to the property, the long-term debt, that minus 60, we've now accounted for on the cash flow statement. Proceeds from common stock. Wow, we issued $90,000 of common stock. So our common stock account went up from 188 to 278. So that's a plus 90. Keep in mind, debit cash for 90,000, credit common stock. So common stock went up with that additional credit, and we received cash for that, plus 90. 50 plus 90. Oh, I got to take care of my dividends. My retained earnings went up by 5,000. Net income was 10, so it should have been plus 10 in retained earnings. The only thing I subtract from that is dividends. It must have been a minus 5 to get to the 5. And I can check my supplemental. Yes, that's right, minus 5. We paid dividends. So 140 minus 110, 30 minus 5, 25 plus 25. So plus 30 minus 45 plus 25, that equals 10. So there was according to this, my math, a plus $10,000 increase in cash. And by the way, I can see here, yes, there was an increase in cash, but I got to show it to my investors. Plus 10 plus 45 equals 55. Check. I have accounted for every dollar of cash flow, and I put it in to operating, investing, or financing. And that, my friends, is the cash flow statement. Now, if you're in my class, I actually put 5 of these on Canvas, so you could actually work 5 of these, and you might want to, because you're going to do one on the last exam for this course. To me, the cash flow statement's almost like brings everything together from all of the accounting that we've been doing throughout intermediate accounting. So it's a great way to end it. Glad McGraw-Hill ends it like that. And again, my thanks for all these lectures from McGraw-Hill and for Spicer, Nelson, Thomas textbook. Really appreciate it, and certainly appreciate you listening to me, you poor people. So again, hopefully my only goal in this, if I can help a few students get over the hurdle of accounting and maybe graduate with an accounting degree or become a CPA, you can do really well financially that way. And I just wish you all the best. And again, thank you for listening to my lectures. And we'll talk to you later. I'm going to go celebrate now. I'm all done.